Gentlemen, good day and welcome to Q2 FY2024 conference call of Inox Green Energy Services Limited, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mohit Kumar from ICICI Securities. Thank you, and over to you.
Thank you, Yashashree. Good evening. On behalf of ICICI Securities, I welcome you all to the Q2 FY24 earnings call for Inox Green Energy Services. Today, we have with us Mr. Devansh Jain, Executive Director, Inox CFL Group, Mr. Kailash Tarachandani, CEO, Inox Wind, Mr. S.K. Mathusudhana, CEO, Inox Green Energy Services, and other senior members of the management. We'll start with opening remarks by the management, followed by Q&A. Over to you, sir.
Thanks, Mohit. Good evening, ladies and gentlemen. A warm welcome to all of you to the Q2 FY24 earnings call of Inox Green Energy Services Limited. The company announced the Q2 results at its board meeting held on Friday, 27 October. The results, along with the earnings presentation, are available on the stock exchanges as well as on our website. Before we move ahead, let me quickly take you through the financials for the quarter. I am pleased to announce that Inox Green has reported consecutive quarter of profits. During Q2 FY24, on consolidated basis, IGCL has reported revenue of Rs 66.8 crore in Q2 FY24 versus Rs 65.6 crore in Q2 FY23. EBITDA of Rs 31.4 crore versus Rs 21.6 crore in Q2 FY23. PAT of Rs 5.7 crore versus a loss of Rs 8.1 crore in Q2 FY23. I will briefly provide an update on our business operations and outlook before we open up the floor for Q&A. Inox Green is a stable, asset-light, long-term annuity cash generation business. It primarily operates in the business of providing long-term O&M services for wind farm projects. The company has long-term service contracts with its customers, including comprehensive contracts and common infrastructure contracts, with built-in annual escalations, resulting in very sticky revenues and stable margins. Inox Green's current O&M portfolio stands at 3.2 gigawatts. The company is committed to almost doubling its O&M portfolio from current levels to 6 gigawatts by FY26 through both organic and inorganic means. On the operational front, we have been able to improve the availability of turbines in our portfolio. For Q2 FY24, the overall machine availability was approximately 96%. During the quarter, our subsidiary, IFOX, won an order from NLC India for the O&M of its 51 megawatt WTGs located in the state of Tamil Nadu. The scope of the contract comprises comprehensive O&M, including power evacuation system, for a period of 5 years with the revenue realization of 40 crores inclusive of taxes during the contract period. Earlier in October 23, Inox Green signed a term sheet for divestment of 100% stake in 50 megawatt Nani Virani SPV for a consideration of around 290 crores. This divestment is part of the strategic decision taken by the company to become net debt-free, a status which will be achieved once the transaction concludes within the current financial year. India's wind energy sector is in the midst of an extraordinary surge, and we anticipate this momentum will only gain further momentum in the years to come. The powerful sectorial tailwinds we are experiencing are poised to drive the significant increase in India's wind energy capacity over the next decade. This expansion will be fueled by a combination of factors including annual central government auctions of wind and hybrid capacity, state-level auctions, growing retail demand, the increasing commitments of the commercial and industrial, which is C&I segment, to green energy, and the emerging demand stemming from the green hydrogen ecosystem as well. This collective effort is expected to result in an additional 100 gigawatt of wind energy capacity in the next 8 to 10 years, a substantial increase from the current 44 gigawatt of installed capacity. In line with this growth trajectory, our parent company, Inox Wind, has set its sights on executing a minimum of 500 megawatts of orders annually, commencing from the fiscal year 2024. This added capacity will seamlessly integrate into our portfolio, benefiting from the synergistic relationship we share. Moreover, we are confident of organically adding 1,500 megawatt to our portfolio during the fiscal years 24 through 26. Looking at the Inox landscape, there are substantial opportunities, particularly in the realm of unorganized and fragmented wind fleet O&M players, owning assets from distressed OEMs, representing a potential 10 gigawatt opportunity. Our subsidiary iFox has been performing well and has won an order from NLC India for the O&M of 51 megawatts of turbines. Both Inox Green and iFox are well positioned to seize a significant portion of the 10 gigawatt opportunity, and we are actively engaged in discussions with third-party wind O&M service providers regarding portfolio acquisitions. During the past quarter, our unwavering commitment to enhance the operational and technical performance of the turbines in our portfolio remained at the forefront of our efforts. We continue to strengthen existing client relationships and actively work on forging new ones. Our steadfast pursuit of leadership in asset management and operational excellence is the driving force, and we are confident that it will create substantial value for all stakeholders. Our initiatives to achieve cost savings and efficiency improvements are producing positive results, reducing overhead costs and increasing productivity. Our digital transformation journey has started contributing to bring in efficiencies across our operations. We will play a major catalyst role in transition in India from fossil fuel to green energy over the years. As part of the Inox GFL Group, a $5 billion conglomerate with 90-plus year history of contributing to India's growth, and with the support of Inox Wind, Inox Green stands on a solid foundation with strong fundamentals and promising growth prospects. As we continue our impressive journey of growth, we eagerly anticipate the opportunity to create lasting value for all our stakeholders. We will now open up the floor for Q&A. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Preet Nagarsheth from Wealth Advisor. Please go ahead.
Good evening. So my question is, I want to a little bit understand how this business works in terms of getting the orders from Inox Wind, because Inox Wind commits 2 years of free O&M to their customers. So how does Inox Wind, what does Inox Green get as part of this? Is it free, or do they charge to Inox Wind?
Okay, very simplistically put, when Inox Wind sells a turbine, we need to give services, and this is a company owned by Inox Wind at the end of the day. We own 61%. We IPO'd it because we thought there was a great opportunity to merge various other platforms and acquire the 10 gigawatt of assets of there where players have gone bust. Having said that, yes, we give 2 years of free O&M, but that's the cost of doing business to earn the right to earn annuity revenues for the next 23 years.
Gotcha. So basically what you're saying in other words is that the first 2 years of O&M, there won't be any revenue coming Inox Green's way, and subsequently there will be revenue.
Revenue start kicking in from year 3 cash flow wise, but under an INDAS system, the Indian Accounting Standards, you need to straight line the revenue. So we on the P&L side, the revenues are shown from day one. The costs are anyways there from day one. But from a cash flow perspective, the revenue start kicking in from year 3 onwards.
Wonderful. The other question I had is that you mentioned 2 types of contracts, comprehensive and common infra. So what's the rough ballpark number per megawatt for each of these contracts?
So turnkey would be about 8 to 10 lakhs. Comprehensive right now are presently at about 4 to 6 lakhs.
No, I'm sorry, I missed that. Could you please repeat that?
Comprehensive O&M contract is somewhere between 8 to 10 lakhs per megawatt. And for the BOP or the balance of plant, the other services will be close to 4 to 6 lakhs per location or per WTG. Per megawatt, yeah.
And what would be the split between these 2 contracts for the order book that you have?
I mean, it really doesn't matter. From our perspective, we look at profitability. On the comprehensive ones, we run at about 50% or 50% margins. The non-comprehensive ones are slightly higher from a percentage perspective, but because the costs are very, very low on the non-comprehensive side. Having said that, I think as a company, we basically guide for a blended 50% EBIT margin.
Got you. But where I was trying to get is to understand the revenue that would be here. So can I say kind of assume a 50-50 split between the 2 types of contracts?
I think so, but if we just multiply the entire fleet 3200 by 8 lakhs, you'll get a fair, because we have various contracts which may are much older, which would have had a 5% escalation, would have gone to 12, 13, 14 lakhs. So blended, if you just multiply it by 8 to 10 lakhs, you'll get the top line number.
Okay, got you. Okay, wonderful. Thank you. If I have any more questions, I'll come back in the queue.
Thank you. We have our next question from the line of Nikhil Abhyankar from ICICI Securities. Please go ahead.
Thank you, sir. Thanks for the opportunity. So this current NLC contract that we have won, the realizations are looking up at somewhere around 1.5 to 1.6 million per megawatt. So is our scope of work also increased in this contract? Hello?
Yeah. There are scopes involved in that. It's a comprehensive contract, and it is a 1.5 megawatt fleet of light wind. And we have covered all the scopes, and we have guided for the margins. So it's a good contract to get in.
Abhyankar? Mr. Abhyankar? Sorry, since there is no response, we'll move on to the next question. We have our next question from the line of Bhavya Shah, an individual investor. Please go ahead.
Hi, thanks for the opportunity. A couple of questions. First is that when we see the balance sheet, the debtors as on September 23 seem to be too high at 116 crore. Earlier in Q4 FY23 Concall, we had mentioned that normalized debtor levels is 50 crore, around 90 days. So what explains this high number?
Hi Bhavya, if you compare our debtors positions from 31st March, that are broadly on the same line. So broadly there is some increase, significant small increase in the debtors number, but that is in line with the March 23 numbers. As we are billing some of the contracts to our group companies as well, so this includes somewhere around 30 odd crore rupees, which is still to be received from our group company, and the balance is towards the other independent parties. As we have guided that our debtors debtors number would remain in the range of 3 to 4 months, 90 to 120 days, and that is broadly in line with the same.
This 30 crores pertains to Resco, right, which was 40 crore as on March?
Yes.
Okay. Second is, we have loans in current assets of 64.5 crore. So what is this loans under current assets?
So broadly, that is towards the GST credit which we have, which will utilize over a period of time. So whatever the GST credit we receive through the suppliers invoices, that has been parked in the current assets.
Okay. And third is with regard to inventory. Inventory has also shot up significantly from 31 to 64 crore. So
yeah. So the reason for increase in inventory are two. One, as we are aware that we have acquired the iFox, and we are maintaining the third party OEMs inventory as well. So there is an increase of 10-15 crore rupees towards that, and 10-15 crores towards the which is normal course, which you cannot compare on a quarter-on-quarter basis.
Okay.
Meaning the ramp up also. So our overall machine availability has increased to 96%. So in order to increase the machine availability, we are building up the inventory also.
Okay, understood. Okay. Now coming to Nani Virani.
There's about 10 to 15 crores which is coming thanks to iFox coming into the fold. That's the inventory they carry because they've got a diverse set of turbines. From our perspective, our inventory's gone up about 15 crores because we've got the whole fleet rejigged. Obviously, over the course of the next 2 quarters, we'll rejig it. This was a high wind season, so we have to carry certain things. But I think as we move into Q3, Q4, the build-up of 10-15 crores will go off Inox's balance sheet.
Okay, understood. Now just coming to the net debt for Inox Green, as on September we have around 200 crore net debt, correct?
So broadly the net debt as on 30th September is broadly 200 odd crore rupees, out of which 150 odd crore rupees we will receive towards the Nani Virani equity, and 50 odd crore rupees towards the towards the receivable and the operation from the operations. So broadly, as we have guided, by this year we will become a net debt free after this Nani Virani transaction got concluded.
Okay, so by March we should see net debt free balance sheet for Green.
Hopefully.
Okay. And one last thing, guys. The total assets of Nani Virani is 289.5 crore. So that means that we'll not have any one-time gain on sale of assets, correct? Like it would be barely 50 lakhs kind of number.
Gain or neither loss. So that is towards the.
But Bhavya, that's on paper because effectively we've only built this asset, right? Under Inox Green. Look at historically all the assets we sold to Adani and Torrent and various other term sheets which we had, keeping in mind the related party transactions, we've priced it at the highest price. So effectively, yes, there would be a profit, but on paper you would not see that profit.
Okay. Understood. That's it from my side. Thanks for taking all the questions.
Thank you.
Thank you. We have our next question from the line of Jatin Chawla from RTL Investments. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, 2 questions. One is trying to understand the seasonality in the business. Per se, it would seem that this business should not have too much seasonality. But when I look at last year's numbers as well as what we have achieved this year, from a EBITDA point of view, first half last year EBITDA was 40 crores, full year was 100 crores. Similarly, this year also, it seems the first half is slightly on the lower side. So is there something that causes seasonality on the EBITDA side?
As such, there is no seasonality in the business, as you rightly mentioned that. But last year is not comparable because in last year there are certain trading income that we have just created the EPC business in the last year. So that is not comparable.
So I'm comparing with what you report the EBITDA from O&M. I'm just looking at those numbers.
So yeah, if you see the last year, what we have reported in our investor presentation, that if you see our EBITDA margins and the revenue are broadly in the line on a quarter-on-quarter basis. So broadly,
first year EBITDA last year was 19 crores, second year was 21 crores. So roughly first half was 40 crores, whereas full year you reported 102 crores.
Yeah, so that's what I'm saying,
No, again, I think where you are going wrong is, I think when you look at the EBITDA from last year, you're seeing EBITDA from traded goods as well, because we can't remove the EBITDA from traded goods.
I'm looking at only EBITDA from O&M.
नहीं, वो आपको नहीं पता चलेगा because we could not apportion the profit margin on the traded goods in that. So while you see this on the balance, when you see it on the presentation on slide 3, you can't make out from that. So there's about 7 to 8 crore rupees because under related party you have to add there have to be related party compliances. So while we are not in the business of making profit on traded goods, historically there have been traded goods. Plus there were various other charges given that this entity had not been demerged from the EPC part, plus the charges for the IPO. Now all those items cannot be put on this presentation. You can get on a call with our finance team. They'll be more than happy to take you through micro details of one-time charges, the IPO expenses, etc., etc. Having said that, if you look at H1 this year, our EBITDA from operations will be close to 62 crores. Not from this presentation, because this presentation is only showing you 30th September. If you look at the balance sheet, it's 62 crores.
No, I have the 1Q numbers also, the same crores. Presentation. Yeah, but that includes 16 crores from the power generation side, right? So if I take that out, it is...
it's 62 crores in H1. So if you extrapolate that, the EBITDA in any case is on a 125 crore run rate. And naturally, as capacities get added and various other value-added services kick in, the profitability of the company increases. But otherwise, compared to 100 crore, if you look at it, we're on a 125 crore run rate.
Oh, I think so. Is that something that I'm not understanding? Because when I look at your,
you can connect with us offline, and we can go through, the greater details about the, all the details, whatever the queries you have.
Okay.
Thank you. We have a next... Sorry, sir.
Yeah, please go ahead with the next question.
Yes. We'll take our next question from the line of Preet Nagarsheth from Feltz Advisor. Please go ahead.
Yeah, sorry, just one last question. What kind of ROCE should we anticipate from next year onwards for this business?
Look, it's I don't know how to, frankly speaking, because of the gross block, given the nature of the business, as a result of that, your ROCs look muted because you have depreciation of virtually 50 odd crores. But we have zero capex in this business. So effectively, if it wasn't for INDAS, our ROCs and ROEs would virtually be infinite. But given the fact we have the 500-600 crores of gross block, which keeps depreciating, obviously the ROCs and ROEs keep moving up as the depreciation happens, since we're not building any new common infrastructure under Inox Green. But Manish?
But broadly, the ROC and ROE in the range of 18 to 20%.
Wonderful. Great. Thank you. All the best, guys.
Thank you. We have our next question from the line of Darshit from Crown Capital. Please go ahead.
Hi. Good evening, sir. Thank you so much for taking my question, and so congratulations on a great set of results. So just wanted to know, when we are saying we add around 1,000 megawatts every year, so that would mean our revenue would be very planned way, maybe if we the 8 lakhs, that will be around 80 crores addition every year in revenue we can expect. Is that a fair way to look at it, or is there some changes in that? And number two, sir, in terms of risk, what do you see that that can maybe act as a speed bump to our growth, in case we are not getting Inox Wind is not getting some order, some competition intensity comes in, or we not be able to get inorganic acquisitions. So just a bit broad understanding that what are the risks that you see and how are they mitigated in case you don't see their high risks?
Still answering to the first question, yes, you can take it in that manner. Because of 1,000 megawatt annually we are planning to add, minimum 500 will be coming from organic growth and 500 will be coming from inorganic addition. And second, adding to the second question, yes, there is no dearth of opportunity in the market. Inox Wind is going to going to have a great growth, and this is a very, very positive market right now, and everybody are looking very optimistic, and yes, we will beat our expectation.
I think, again, just to be honest, in terms of growth going forward and in terms of risk, I think the fleet which we already manage is an annuity business. So to the extent that we already manage, these are very, very secure contracts. long-term people are married to us for the next 20 to 25 years once you sell a turbine. So this is very, very stable cash flows. The past 13 years, we've historically been north of 50% EBIT margins and will continue to be that. In terms of the upcoming growth, just for your information, Inox Wind's order book currently is close to 1,300 odd megawatts. The market is just on the cusp of massive explosion. So frankly speaking, adding 3 gigawatts through a mix of organic and inorganic over 3 years is I think fairly routine or fairly nothing out of the ordinary. Yes, it would still mean doubling of a company, which is phenomenal. But having said that, adding 3 gigawatts over 3 financial years organically and inorganically is frankly not rocket science.
So that's very great to hear, sir. And just wanted to know, so maybe as we will be retiring most of our debt this year, so we could assume that there would be very less finance cost next year. And as we said that I don't think there should be any finance cost. I mean, there may be routine 1, 2, 3 crores of normal banking charges, but I think the internal accrual should be earning that from FDs as well. I don't think we should have any finance cost in the next financial year. Perfect, sir. And in terms of our fixed asset gross block movement, so as we are not going to do any other capex, so maybe by FY26 we would be able to eliminate most of our property and plant with our depreciation, and going forward we would not have significant depreciation. Would that be a fair assumption?
So broadly, we are depreciating at the run rate of 50 crore per year. So broadly, next, that will take certain time, but obviously your net block keep reducing up to the extent of 50 crore on a year-on-year basis.
What's our net block right now? 600. So obviously it will take 12 years for it to become zero, for then ROCs, ROEs to be infinite. But naturally, as the gross block keeps getting depreciated by 50 crores every year, your ROCs, ROEs keep going up.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, please restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Nikhil Abhyankar from ICICI Securities. Please go ahead. Mr. Abhyankar, your line is unmuted. Please go ahead with your question.
Yeah, thanks for the opportunity, sir. My line got dropped earlier. So on the NLC contract, so the realizations are high, so will our profitability will also be high in this contract?
Look, I think we're going to get into specific contracts. We broadly guide for 50% margins, and I think that's going to be true for the entire. We won't get into micro details of specific contracts.
Okay. And so there are certain contracts in which the customers use only our common infra. So are we looking to upgrade them to into comprehensive O&M as well?
Look, it's a part of ongoing business. I think we're looking at various value-added services. Mathu and the team are doing a great job adding a lot of other value-added services. There are customers who are talking to us for converting shared infra to common infrastructure. So it's part of the journey. Frankly speaking, at the end of the day, whether we do comprehensive or semi-comprehensive or only common infra maintenance, we at the end of the day need to ensure our profitability is maintained.
Understood. And sir, are there any contracts coming up for repricing in the medium term?
Yes, certainly. They keep coming up. Obviously, as a 10-year period comes to an end for some of the older projects, I think in the next 2 to 3 years, we'll have about 200 to 50 odd megawatt, which will come in. Medium term, those pricing will have to be reset. Yes, the common infrastructure is controlled by us, so naturally all those contracts will remain with us. But yes, we will reset those prices.
Thank you. We have our next question from the line of Naitik Mohta from Sequent Investments. Please go ahead.
Good evening, sir, and thank you for the opportunity. So I just have one clarification. I believe the Nani Virani project is under the Inox Green Belt, and the money that would be flowing from the divestment would also flow through Inox Green. But at the same time, we see these finance costs that are booked by Inox Wind, some 17 and 7 odd crores, a total of 25 crores in H1 FY24. So I'm just unable to add that up. That does not flow through the P&L of Inox Green. So could you just explain a bit on that?
7 crores.
So I
I guess you need to pardon your question, as we see the finance cost in this particular financial year in Inox Green is only 11 odd crore rupees, as against the 30 crore rupees in the last financial year, last 6 months on 6 monthly results.
I mean, again, if you have a 200 crore borrowing at 10%, that's 20 crores per annum.
Yeah.
So we're at 11 crores for H1. So your question didn't really make sense.
No, I'm asking like at the Inox Wind level. So I believe under the Inox Wind, we booked some 17 crores of finance cost regarding the Nani Virani project. And that finance cost hasn't flowed through Inox Green. While the project itself...
Looking at Inox Green, I don't think we will comment on Inox Wind, but from a Green perspective, the balance sheet of Green has interest cost of 11 crores for H1. If you extrapolate it, that would be 22 crores. So for 200 crores of debt at 10%, that would anyways entail 20 crores of cost, right? And now with Nani Virani going off the balance sheet, this will virtually become zero. Inox Wind has no role to play in this, frankly speaking.
Okay, so the interest costs regarding the Nani Virani project, I believe you mentioned in the previous call that that it will take around 3 to 4 months to close that transaction. So some would continue for the quarter 3 and then cease to exist in quarter 4. Like that would be a proper understanding?
Yeah, broadly.
Yes.
Broadly,
So it has already been placed under a discontinued asset.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.